Now, when I ask the question, why do you use the 200-day moving average? The first thing that pops in your brain is the next topic is how to use moving averages. So, what is a moving average? In a simple way, it is averaging out the closing prices of the previous data point. So, there are two ways we look at moving averages, the simple moving average and the exponential moving average. The simple way to calculate a simple moving average is you have, say, data points 11, 12, 13, 14, 15. You have 5 days. You add up these numbers, divide by 5. That becomes your first point of the moving average. So this is the simplest way a moving average is used. The next one is a little complication called as the exponential moving average. As you see the formula up there. Now, rather than going deeper into the formula, the conclusion is when you use exponential moving average, it gives more weightage to the recent data points. Now, this becomes a good moving average to use if you are looking at crossovers. Because when you are looking at crossovers, you want a faster turn. So if you are using crossovers, exponential moving average is a better moving average to use. And essentially, when you look at the data points, there is not a lot of difference in both of them all the time. So now that we've understood what are moving averages, we go to how to use them. So there are the 4 things which we look out for. First is identify the trend. Second is because the world uses it. It's interesting, we'll see later. The third one is for moving average crossovers, and finally to use it as stop losses and trailing stop losses. Now we go to the first part, which is basically identifying the trend. Now when you look at a chart, which is generally a candlestick chart or a bar chart, you'll see there is a lot of noise because there is open, high, low, close. So it looks a very, say a heartbeat type of chart. When we go to the next sort, which is basically looking at the closing prices, then you look at the next chart. The same chart, if you see now, looks a little more smooth. Then you go to the next step when you look at a moving average chart for the same price data, and suddenly it becomes smooth. It becomes easier to see the trend, wherein it is much more clear that higher tops and higher bottoms are made. So when you look at a moving average price chart, removing all the candlesticks, it becomes much more easier, much more simpler to understand the trend. So when we understand the trend, how do we use it? So a simple way we generally use is, there is a saying, not a lot of good things happen below the 200-day moving average. So basically what it implies is, till the time the stock is above the shorter term or the longer term moving average, the trend is up. Now, in the same way on the downside, once the stock starts breaking the 50-day moving average, the 200-day moving average, implies the trend is definitely lower and grinding lower. Now, the second part is, we use the moving average because the world uses it. Now, if you look at the most talked about moving averages, it is the 200-day moving average. Now, when I ask the question, why do you use the 200-day moving average? The first thing that pops in your brain is, it's a yearly moving average. But the fact is, how many trading sessions are there in a year? You can go to NSE India site and you'll notice every year there are 240 to 250 trading sessions in a year. Then how is the 200-day moving average the yearly moving average? Because when the world started looking at moving averages, back in the day, there used to be only 200 trading days in a year. If you go back to the history of Indian markets, there used to be an 8-day holiday for Diwali. In the same way, we still have an annual holiday in the Chinese market. So essentially back in the day, there used to be 200 days. Today, we have much more higher. But still, the world is using the 200-day moving average, so we also use it. Now the third part is moving average crossovers. Now, this could be the first algorithmic trade back in maybe the 1930s, 1940s, 1970s, which is where you used a very simple crossover system, which is where a shorter term moving average crosses a longer term moving average. For example, the 10-day moving average crossing the 20-day moving average. Now 10 days is roughly 2 weeks of data, 20 days is a month of data of trading days. So a 10-day crossing 20-day on the upside is a bullish signal, and vice versa. In the same way, you would look at the 50-day moving average, which is like a quarter's data of trading sessions, and 200-day, which is almost closer to a year. When the 50-day moving average crosses the 200-day, it is called a golden cross. In the same way, when it happens the other way, it is called a death cross. Now, these are very simple systems, but it works brilliantly in a trending market. The problem is when the markets are in a sideways zone. What happens is a lot of these crossover systems will give you a buy and then give you a sell, and you will keep getting whipsawed in that period. But it will work superbly well in a trending market. Now, a lot of people use a mix of various moving averages. Somebody uses a Fibonacci number moving averages like 13, 21, etc. But as many combinations you take, the fact is, in a trending market, it will work really well and it will help you to ride the whole move, because it is difficult to ride a move. So using a crossover system helps you in a trending market. In a sideways market, it will hit you as well. Now, let us look at a few examples. Now, this example, if you see, this is for the Nifty back in 2003. You got a nice 50 to 70% move in higher tops and higher bottoms after the golden cross. And then you got stopped out. Then, if you look at the next one, this is somewhere in 2013. Before that big breakout, there were a couple of whipsaws. Then you got again a golden cross and you got a solid rally going from 6,000 to 9,000. Then you got a bunch of whipsaws again. But even if you took all the trades along the way, you would still end up with a positive return. Now we look at the next chart between 2008 to 2014. There were a bunch of whipsaws in 2010, 11, 12 before that big trending move in 2013. So one has to be careful while using moving average crossover systems, because in a sideways market, there will be multiple whipsaws. So you have to wait for a crossover and also use price action along with it to understand the market behavior. Now, the last topic is using moving averages as a stop loss and a trailing stop loss. Now, there are various ways people look at stop losses. Somebody looks at the recent swing lows, which is generally very deep. Somebody looks at candlestick lows, which is very close to the current price. Now, even after you decide this, you are trading different stocks which have different volatilities at different point of time. You cannot have a 5% stop loss for an ITC and also have a 5% stop loss for a Yes Bank. Both the stocks have different volatilities. So when we use a moving average stop loss, it is the characteristic of that stock at that point of time. So it keeps on adapting. So there are periods of time when the stocks are very volatile. At that time, moving averages will go slowly. When the volatility is much more lower, it will be much more flatter and it will keep on adapting. So a moving average stop loss is one of the best ways to keep a stop loss, and it's very simple. The various moving averages which we can simply use is, for example, if you are looking at a swing trade, you can have the 10-day moving average stop loss or the 20-day moving average stop loss. If you're looking at a much more positional view of say 3 to 6 months, you can be using the quarterly moving average, which is the 50-day moving average. And for a very long-term trade or an investment, you can use the 200-day moving average. So you can use a bunch of this moving averages simply as stop losses. Then the next part is, now you've got into a trend. The stock has moved from 100 to 120. Now how do you ride it? Now if you were to ride it purely on higher tops and higher bottoms, the last bottom could be really low. And that is where a moving average trailing stop loss helps you play the momentum in a big way. So the trailing stop loss could be your 20-day moving average or the 50-day moving average as per your time frame. But what we've noticed is people also use various combinations, but we try to keep it simple to 10, 20, 50. That's the best, simplest solution for a stop loss. It is quick, it is easy to calculate risk rewards. And essentially it is not dependent on one data point at one point of time. It is a characteristic of that stock in different conditions. So this is the way we use moving averages. To sum it up, identify the trend, use the 200-day because the world uses it, moving average crossover systems to understand what the trend is, and finally the stop losses and trailing stop losses.